afternoon, everybody, and welcome to our second Ifac Pinion tariffs briefing. Once again, this afternoon, I'm glad to be joined by Brian Kuehl from our partners Pinion in the US. Brian, as mentioned in the last call we had, is Director of Government and Public Affairs with Pinion, and he also helped form the Congressional Agricultural Trade Caucus in the US House of Representatives, which is a cross-party caucus. So Brian really has a finger on the pulse of what the feeling is in DC and what's happening on the states at the moment and what the thoughts are on the whole tariff situation. So I guess we'll get straight into Brian. And it's hard to imagine it's over a month ago since we last spoke, which was the 11th of March. And I remember on that call, the big thing you were talking about was about the April 2nd, the date where all the tariffs were going to be announced. And I'm not sure if we all realized on the call how big the announcements were going to be on that day in the Rose Garden. But I guess, first of all, what I'd ask you is, with the breadth of the tariffs and the actual rate that was put on many countries, what was the initial feeling like in DC after the announcements, and both, say, are in DC and also, say, in, say, the states in more general and out in the ag communities? What was the thoughts of, let's say, US voters on what President Trump announced on April the 2nd?
Well, and first, thank you, Carol, for hosting this webinar and for having me on again. It's a delight to be with you and to be able to talk about these topics. You know, I think most people, most analysts were caught off guard by the depth and breadth of the tariffs on April 2nd. I mean, we all knew there were tariffs coming. I think the markets reflected sort of the shock of how widespread those tariffs were, the number of countries that they applied to, the size of the tariffs, and kind of the shambolic way they were rolled out. You know, this kind of funny math and you know, putting tariffs on islands that hold only penguins, I think, did not do a lot to instill confidence. So I think the initial reaction was kind of disbelief. Having said that, I think there are a couple of things that have mitigated that somewhat. Number one was the realization from the U.S. perspective and U.S. agriculture perspective was that Canada and Mexico were largely left out of that tariff war, the reciprocal tariff. Mm-hmm. There have been tariffs put on Canada and Mexico. They have, at least Canada has retaliated. But the larger tariff discussion, the retaliatory tariffs or reciprocal tariffs, did not apply to Canada and Mexico. And I think that presented some stability because Canada and Mexico are two of our top three trading partners. The other thing, obviously, is Trump then rolled back the reciprocal tariffs for 90 days based on the bond market, the escalation in yields on the bond market. And that, I think, caused some stability. And now there's, of course, I think the Trump administration's leaning into this discussion that they'll try to strike deals, maybe with the UK, maybe with Japan. I think they're doing that in large measure because they recognize this is a touch and go situation that needs to be stabilized.
Yeah, very good. And actually, it's interesting there that you mentioned the bond market and not the stock market, because most people would have noticed the huge drops that were on the stock market, and that seemed to have been ignored, let's say, by President Trump and the administration. It was almost like, yeah, we'll have to take a little bit of pain, but it'll be worth it long term. Maybe at a macro level, can you just maybe to some of the people here that are tuned in today, kind of just go, why is that movement that you outlined there on the bond market? Why was that so critical to get the administration to, say, back down a little bit on the tariffs? What does it mean to the states when the yields on the US bonds spike like they did?
Yeah, so there's a couple of things that are going on there. Bonds are obviously, it's like the UK, the gilt. It's the treasuries, the debt that the United States issues and that investors purchase. And typically, bond yields move opposite of stock market prices. So if the stock market is crashing, we would expect to see yields come down because bonds are going to be a more attractive vehicle. People are going to want to buy bonds. But in this case, that did not happen. What happened was people were running both from the stock market and from U.S. Treasuries. And that was really startling for a number of reasons. I mean, number one, it I think looked to some in the administration like we were losing the faith of the market in the U.S. government and the power of the U.S. economy. So that's a pretty big, stunning concern when you realize that your economy may not be viewed as stable as it should be. Number two, I think there was a concern that the reason that people were getting out of treasuries is because a lot of the hedge funds were needing to sell the treasuries to cover the margin calls on their stocks. And that's a really bad scene. And where we've seen that type of alignment before is like the 2008 recession. So, there was a news article where President Trump said he was willing to deal with a recession, but he didn't want to deal with a depression. And I think that's, it's a little cavalier. I think we'd all rather not go into a recession either. But I think there is a pain point where President Trump realizes, if he drives the U.S. and global economy into a depression, it's not going to end well for him. So I think that caused him to pull back.
Yeah, and interesting because the last time we were chatting, and we were looking back, say, to 2018 tariffs, and at that time, let's say the dollar strengthened, which took away, say, the edge of some of the tariffs for countries who were importing into the US. But this time, the dollar has gone the other way and it's weakening and has weakened significantly, which means now you've got countries, whether you're here in Ireland or whatever, and yeah, it's 10% or 25%, whichever the tariff is, depending on what you're exporting. But now you've got a weaker dollar as well. You've got to contend with, which again is making your product even more expensive going into the States. And they probably are all interconnected, but do you think that dollar rate will kind of settle, hopefully, or do you still think there's a lot of volatility left with where it may settle?
Well, I think there's a lot of volatility, and I think that because I think the amount of number one, the amount of uncertainty is still tremendous. As much as the White House has tried to calm the waters and will try to calm the waters again, I think with a deal with the UK and a deal with Japan, you're talking big numbers. I mean, it's important to know the U.S. before Trump began his second term in office, we had an average tariff rate of a little under 3%. And now, and it kind of gets lost in the shuffle, even though the reciprocal tariffs have been postponed for 90 days, he still put 10% tariffs on all inbound goods except Mexico and Canada. So you kind of lose, you bury the lead a little bit. It's like 10% is still a really big deal. And then you add on top of that 145% tariffs on goods coming in from China, uncertainty about are we going to see tariffs on computers, electronics, and chips? Are we going to see tariffs on pharmaceuticals? He's threatened tariffs on lumber. So, not to mention we have steel and aluminum tariffs and we have auto tariffs. So I think all of that says we're a long way from being out of this turbulence.
Yeah, it's very serious. I mean, you're talking there, with China, and I mean, China didn't put on high reciprocal tariffs itself, and it almost seems to be a game of chicken now between the US and China. But what are you hearing, say, on the ground in the US? What's the thoughts there? Is it that China will eventually back down and come and make a deal, or is this going to be much more long term and it's going to drag on for the rest of the year, maybe between China and the US, or what way do you think? Now, I mean, you can't call this because who knows, but what way do you think it may play out between China and the US as we go through the year?
I don't think we will have a fast deal with China. I think if we get a deal with China, like in 2018, recall President Trump put tariffs on, we escalated and ultimately got what he called a phase one agreement with China, which to its credit had some redeeming qualities. It addressed phytosanitary standards and a number of issues that U.S. ag producers care about. It pledged the purchase of a huge amount of U.S. ag commodities, only partially which was realized. But I wouldn't rule out a U.S. China deal. I don't think it happens quickly. It's not going to happen in the next month or two, I wouldn't think. I think there are too many other trains ahead. The other thing I think that is an important dynamic to recognize, and I think is frustrating for me personally, is if you start with the premise that China is a problem and we need to correct China's behavior or we need to isolate China, it seems like the appropriate response would be, let's isolate China. Let's get all of our allies together and go after China together. And that's, of course, not the way this trade war is unfolding. President Trump has picked fights with virtually every country on the planet. And I think that emboldens China because China now sees opportunities. In fact, China, the Premier Xi was in Vietnam this last week. I think they're doubling down on their diplomatic and economic outreach. And I think that points to the risk of a longer trade war, certainly with China, than otherwise would have been needed.
Yeah, and you mentioned there, like, yeah, and the deal that was signed back in 1819 with China, and there was a large amount of ag exports from the US into China, and a lot of that maybe hasn't happened. But is there a huge worry now in US ag with the tariffs that China has put on, especially on the likes of, say, soybean, on pork, and on products like that? Could this have a huge effect, say, on US farmers with the amount that is or has been exported to China, and what's going to happen for the season that we're in right now? And people have seeds in the ground, or the seeds are bought. So what's going to happen and what's going to grow is what's going to grow. But what are the markets going to look like for farmers in the US when they go to sell in the autumn?
So yes, I think there's a lot of concern, and specifically, you mentioned soybeans, 16 or 15 billion dollars worth of U.S. exports to China last year. So the largest market for our Midwest farmers that are growing soybeans. So I think there's a lot of concern about what you can't just replace that market. And in the 2018-2019 trade war, the U.S. agriculture lost about $27 billion worth of export value, and most of that was soybeans going to China. So it is a very big deal. Um, if there's good news, and we all look for good news where we can find it, from the U.S. farmer perspective, we are in planting season, which means we have a number of months before harvest. It won't be till this fall. And so if the trade war can calm and resolve somewhat by fall, maybe this damage isn't as bad. If the trade war is still hot come September and October, then I think things look pretty grim for U.S. agriculture.
Yeah, and you might kind of expand a bit there as well. So that's the export side, let's say, for US ag that the worries are. But even in the internal market, like with USAID and other big purchasers of US farm goods, like in farm produce, there has been a fall off in that market as well for the last number of weeks and months, and there with some decisions from the Trump administration.
Absolutely, and I think look, going into the 2018 trade war, U.S. agriculture was in a pretty strong place. We'd had some high commodity prices. We'd had low input costs. As a result, farmers had high liquidity. They had cash reserves. They weren't heavily leveraged. Um, the 2018 and 2019 trade war and the COVID pandemic, I mean, there were a lot of factors that contributed, all combined to really squeeze American farmers. We've seen lower commodity prices and higher input costs. So farmers today are much less financially secure than they were in 2018. And I think what that means is number one, they're going to be more risk adverse. So if you're a farmer and you're thinking, should I buy a new combine? I probably wouldn't be buying a new combine right now because you don't know where your markets are going to go. You don't know whether you're going to be able to sell your crops. You don't know what's going to happen with the cost of equipment. So I think farmers are probably going to be hedging their bets a little bit. Um, so that of course has a dramatic input or impact on providers of that equipment. So I think that's one factor to watch. Um, and then I think again, once we get through into harvest, I think that's where we could see real impacts in terms of farm bankruptcies and those types of downturns.
And let's say, because you guys are dealing with farmers every day, like, are you redoing forecast budgets or anything like that for the year ahead? Or even, let's say you mentioned there, let's say that there were farmers were in a better financial position the last time kind of tariffs arrived, but is there a willingness, or is there credit in the market there, say within the banking system for ag, that will there be support for farmers that way? Or is it just too tight that maybe banks will look at farmers and go, no, it's too risky at the moment, and they will be left go under, unfortunately? Or what way do you think that might play out?
Well, no, I mean, I think President Trump and Secretary Rollins, our agriculture secretary, have both been very clear that they are planning another series of government subsidies out to farmers to salve the wound that is being caused by trade. So that will help a lot. In the last trade war, they moved about $28 billion out to farmers, about the same amount farmers lost in the short run. So that kept farm bankruptcies certainly from being a lot worse than they were. And I think we'll see the similar dynamic there this time, and that of course will flow into the private credit markets as well. I think banks will continue to loan, but our advice, I think, from Pinion is this is a time where farmers need to be all the more smart and run all the tighter of an operation. In good times when commodity prices are high, everybody looks like a genius. People are feeling good, like I'm the smartest farmer in the world. And it's only when things tighten that you realize if you don't have your act together, you go under. And so I think we spend a lot of time working with our farmers, as I'm sure you do, trying to make sure that people are making those right decisions and planning ahead and being prudent in the way that they're planning their capital budgets and forecasting how their farm is going to operate, because there's just less room for error at this point.
Yeah, agreed. And I mean, so we've covered, let's say, where the output prices may fall, looking at kind of more the capital side and machinery and that. But even say on the direct inputs now, I know probably most seeds and stuff are locked in at this stage, but are you seeing movements in the US, say, in the prices of fertilizer and other farm inputs, or are they staying level enough through this period at the moment?
No, we've definitely seen some price increases. This is a really interesting part of the discussion because when President Trump announced his reciprocal tariffs and then backed off and went with the 10% across the board tariff, he initially was saying he wasn't going to have any exemptions. He did ultimately allow a number of exemptions specifically on farm inputs. So fertilizer, farm chemicals, a lot of which were exempt. The trick is, as you look at these tariff codes, some inputs appear to have been missed, and
Yeah.
so it's not across the board that everyone's happy. There's some pesticides or some farm chemicals that were not on that list, and that is causing some concern. Now they may still adjust, they may come back and clean that up, but it hasn't been as good as initially believed.
I've got you. And like trying to, because that was one thing that was kind of interested in, let's say, is looking from this side of the water was, let's say, the actual people who are working in the ports or working at where customs are. Did or does the US, say, Customs Service, does it have the capabilities or did it have the capabilities of the original Trump tariffs? There were so many different levels, so many different codes. Would it have been able to handle what was being imported on a daily basis if it was 20% from the EU, 10 from the UK, 45 from Vietnam, 34 from China? Was that capability within the system, do you think, or what were you hearing anything on that?
Yeah, I think it would have been a strain on the system. I think the bigger challenges are twofold. Number one, the idea of putting taxes on de minimis imports, so less than $800 purchases. Um, that I think is beyond the pale. I don't think CBP or Customs and Border Protection has the capacity to regulate at that level right now. It's just too much of a volume. So I think we're already seeing some potential flexibility on that issue or delay in implementation. Um, I also think if the tariff rates had been on individual products as opposed to on an individual country, that's much harder to administer. If you have a 5% tariff on motorcycles and 6% on t-shirts, as opposed to, okay, across the board, everyone has 10%,
Mm.
it's a little bit easier to administer. So I think the US system probably can handle the calculation of the current tariff rates. But it will strain that system. And keep in mind, this is all happening in the context of a US government that is trying to dramatically downsize. I mean, we're seeing 30% cuts to certain agencies, including US Department of Agriculture. So at a time when farmers need help and need assistance, that assistance is drying up.
Okay, and maybe from a selfish kind of Irish perspective, let's say looking beyond ag and everything, one of our main exports into the US, our main export into the US is pharmaceuticals. Now, on the second, pharmaceuticals was excluded, but straight away that kind of popped up of a worry that, like, okay, it's out of the original tariff rates, but that doesn't mean it's going to be exempt forever or just going to get a lower rate. And I know in the last number of days, in the last week, President Trump mentioned both China and Ireland in the one breath almost about pharmaceuticals coming in. Are you, or have you any view or any ideas or hearing anything of what may happen on the pharmaceutical side? Or is that something you're not aware of at the moment and it's anybody's guess where President Trump might come if he comes with something on pharmaceuticals?
Well, I think it's clear he will come with something on pharmaceuticals. I would take that to the bank at this point. He has started what's called a 232 investigation, which under
Mm-hmm.
US trade law is for national security reasons. And a 232 investigation, once triggered, there's 90 days to complete the review. They can move faster than 90 days, but by the end of a 90-day review period, there is a finding on whether 232 tariffs are justified or not. So at the outside, we have a sort of 3-month window. I think it's less likely that it's 3 months. My guess would be it's a month at the outside. And I would expect that we will see tariffs on pharmaceuticals. Now, the challenge, of course, is President Trump ran in part on lowering costs for Americans. Eggs was the big example. Our egg prices spiked because of bird flu. But across the board, I don't think you can raise pharmaceutical costs on Americans and not have that show up in public polling. I think people will be very distressed if they see their healthcare costs going up. So that will temper or shorten the duration of this type of trade war around pharmaceuticals, I would think.
Okay. Yeah.
It is interesting to me that he specifically called out Ireland. I mean, you've definitely been passing the president's lips on that particular topic.
Yeah, it's a fairly big sector here. It's I'll say our corporation tax returns each year. Yeah, it's fairly significant what passes through now. It's like anything, you can look at what is actually physically made and exported and what might be exported, and then patents are held in Ireland and say pass through Ireland just for taxation purposes. There's maybe some debates around some of that kind of stuff, but it is a significant figure here in Ireland. Yeah, it's an interesting one to look at. Like, let's say if you've ever got time beyond agriculture.
I think if I'm not mistaken, Ireland is the largest importer of pharmaceuticals to the United States, followed by China and India.
Yes, yeah.
And Ireland, a number of the pharmaceuticals you import, Keytruda as an example, really important cancer drug. Wegovia for weight loss. I mean, these are things that are in high demand in the United States. So I think, a lot of the generics come in from China and India, but a lot of the name brand drugs are coming in from Ireland. So that's not easy politics to navigate.
Yeah. No, it's going to be interesting. But I guess back to our kind of core discussion there around, say, the tariffs in general and probably Irish ag and agri-food products. So, I mean, we had, as I say, from the EU, the 20% originally, and that was going to put us at a bit of a disadvantage, let's say, even within the island of Ireland, that we were 20 here in the Republic, and the north part of the island was at 10%. So butter, whiskey was going to be different. Now we're all 10 at the moment for the 90 days. But what are your thoughts on the possibilities that, let's say, that there will be some kind of agreements within that 90 days, or will the 10%, do you think, across the board be pushed out further because realistically no trade deals will be signed within the 90 days? Or is it a case of maybe if the EU can come to President Trump and sign a deal to, say, purchase large amounts of LNG and maybe soya as well, if China is still closed, that maybe he'll take that as a win and we might have some kind of an interim deal? Or how do you kind of see this playing out maybe in the next 2 to 3 months is, I suppose, my question, basically.
Sure. So I think a couple of things. Number one, I think it's notable that the Trump administration has definitely been highlighting Japan and the UK for the first deals. And those are, I think, clearly at the front of the line. So I would expect they will have those deals announced sometime in the coming weeks. I mean, they won't be full free trade agreements, but there'll be enough of a deal to say, okay, these countries are now on the nice list and will remove their tariffs. I would expect EU will hang out there for a while. I don't think there will be a quick deal. It looks like the Trump administration has not been. I mean, they've had meetings. Howard Lutnick's been in meetings with folks from the EU, but it doesn't look like they've made much progress. It looks like the U.S. has been slow walking those negotiations. I know that Italy's Meloni is in meeting with Trump, I believe, tomorrow. So that could produce some breakthrough. They certainly, I think, have a good relationship.
Yeah.
But I think all things being equal, I would expect that the EU will hang out for at least a month or two, and maybe through the 90-day period. Ultimately, I would hope we would reach an agreement. I mean, we have so much in common with the EU, but there are some issues that have been thorns in the side of the U.S. and that the U.S. would like to address. The flip side, of course, is services. The U.S. sells so many services. We have a trade surplus in terms of service exports to the EU. And I think if that begins to both be recognized by the US and be put on the potential retaliatory list by the EU, that could turn some heads pretty quickly as well.
Yeah, I agree. Yeah. That when you look at services and goods together, there isn't that huge amount of a gap in trade between the US and the EU. And again, beyond pharmaceuticals, talking from the selfish part of Ireland, a lot of those, we call them service companies, such as your Metas, your X's, your Amazons, your Googles, they're all head office in Dublin for their European market. So again, if something retaliatory comes from the EU side, us here in Ireland might get hit harder than others. So maybe it's something that we're not quite looking for, let's say, at this stage. But I guess because I'm looking there at the time and we're not far off the half an hour now, like that we allocated for this, and we've gone through a lot of information here. But I guess we probably have some people tuned in that, as I say, are exporting into the US, and let's say again beyond the food kind of part into those guys maybe that are caught with the 25%, and maybe it's kind of equipment or farm machinery and that. But is there any few little pointers you would say to them that they should be considering, let's say, if this kind of drags on, like from the point of view of renegotiating contracts, sharing the burden of the tariffs to make sure they keep market share? Or is there anything in those kind of areas, if say a company was speaking to you, that you'd be kind of advising what they should be reviewing or what they should be looking at inside their own door, let's say, for want of a better way of putting it?
Sure. Well, I think a couple of things. I mean, number one, obviously keeping an eye on the health of the U.S. farm economy. Farmers, if the farm economy is not healthy, they're not buying regardless of tariffs. So watching closely what's happening with U.S. farm bankruptcies and sort of sentiment in U.S. ag, which right now I think is relatively solid, but I think things could turn south. So I think that's a critical point. The other would be looking for, are there opportunities to onshore manufacturing into the U.S.? And I know that's easier said than done, but to the extent there's a product that a partner in the U.S. could manufacture and avoid the tariff, that's certainly something to look at. And then I know there's a lot of thinking going on to how do you calculate the price of products that are being exported, and can you reduce that cost to reduce the tariff line? There are whole companies built up just around that, kind of looking at how to do those calculations. But I think the long story short is we're going to have an extended period of uncertainty and some real challenges for ag, I think, both in Ireland and in the United States as a result of this uncertainty.
Great. I guess, yeah, the 30 minutes nearly up now. So I want to thank you, Brian, for joining us again on this call. And it's been very, very informative. And I hope all that were tuned in got as much from it as I have definitely got. And just to say again, yeah, Brian works with our partner company, Pinion Global in the States. And if anybody tuned in here from the Irish side or on the US side want to speak to any of us or to get any advice on how businesses can navigate through this turbulent time, please feel free to reach out and get in contact. So thank you again, Brian.
Thank you, Carol. Great conversation, and look forward to working with you in the months and years to come.
Great. Take care.